Here's something that might bother you. Your mortgage got more expensive, your rent went up, and when you got a pay rise, it somehow still didn't feel like enough. Most people think they understand how that happens, something to do with banks, interest rates, maybe inflation, but almost everyone is working from the same broken model of how money actually works. And that model is taught in schools. It's repeated on the news, and it is quietly, technically wrong. In the next 10 minutes, I'm going to show you what's actually happening inside the banking system with no economics degree, no jargon, just one clear mental model you'll be able to explain to someone else by the end. No conspiracy, no ideology, just the mechanism, the part nobody properly explains. Let's start with a phrase that sounds like it explains everything and actually explains almost nothing. Fractional reserve banking. Say that out loud. It sounds like a technical term that should make everything click into place. And honestly, if you've looked this up before, you've probably come away more confused than when you started. Because most explanations either treat you like an economics professor or treat you like you're 5. So what does it actually mean? Historically, fractional just refers to the fact that banks keep a fraction of what's deposited as reserves, rather than holding onto every pound in a vault. The rest supposedly gets lent out. That's the story. Here's where most people get this wrong. They hear fractional reserve banking, and they picture a vault. Deposits come in. The bank keeps a bit behind. Then it lends out the rest to a borrower. It feels intuitive. It's what most of us were taught. And here's the thing. That picture isn't just simplified. Modern central banks say it doesn't describe how the system actually works. The Bank of England put it plainly. Banks do not simply lend out the deposits that savers place with them. So if that story is wrong, what's the real one? Let's make the old story concrete so we can see exactly where it breaks down. The classic version goes like this. You deposit 1,000 pounds. The bank keeps 100 pounds as a reserve, a fraction. Then it lends out the 900 pounds to someone else. That borrower deposits it somewhere, and the next bank keeps 90 pounds and lends out 810 pounds. And so on and so on. The original 1,000 pounds multiplies into thousands of pounds of money in the system. This is called the money multiplier model. You'll find it in economics textbooks. Teachers draw it on whiteboards. It sounds plausible. Here's the thing. Central banks themselves have said this story gets the order of events backwards. The Bank of England said it directly. Banks do not multiply up central bank money into new loans and deposits. The Fed's own researchers asked, does the money multiplier even exist? And found the standard model doesn't explain how reserves, money, and lending actually interact. So if banks aren't lending out your deposits, what are they doing? Pause for a second. Think about what you actually believe happens when a bank approves a mortgage. A loan officer looks at your application. They say yes. And then, what? Where does the money come from? Here's what actually happens. And this is the part nobody explains properly. Let's say you go to your bank. You ask for a 100,000 pound mortgage. The bank checks your income, your credit history, your outgoings. They decide you're a safe bet. They approve the loan. And now, watch this closely. The bank doesn't go and find 100,000 pounds sitting in a vault. It doesn't move money from one account to another. It doesn't borrow from other depositors. It types a number into a ledger. On one side of that ledger, you owe the bank 100,000 pounds. That's an asset for the bank, something you'll pay back. On the other side, the bank owes you 100,000 pounds. That shows up as a deposit in your account. That's a liability for the bank. Both entries appear at the same moment. The loan and the deposit are created simultaneously. That deposit, The £100,000 that just appeared in your account is new money. It didn't exist 5 minutes ago. The bank wrote it into existence by making the loan. This is what the Bank of England and Spain's central bank both describe when they say that banks create what's sometimes called inside money, money that commercial banks create when they extend credit. And here's the one-line rule you should remember. Loans create deposits, not the other way around. That is the real sequence. Not deposits first, loans second. Loans first, deposits second. Recap. So far, banks don't lend out your deposits. When they approve a loan, they create a new deposit. The money wasn't stored anywhere. It was written into existence. Now, if that's true, you might be wondering, what are reserves even for? This is the part that clears up a huge amount of confusion online, because reserves is a word that gets thrown around constantly, and almost nobody explains what they actually are. Here's the key distinction. Your bank deposit is money for you. You can spend it, save it, transfer it. It's money in the public system. Bank reserves are money for banks. You cannot spend reserves. You have no access to them. They live on the Bank of England's balance sheet, accounts that commercial banks hold at the central bank. Think of reserves as the settlement rail between banks. It's the infrastructure that runs behind the scenes. Here's how it works. You have a mortgage, you spend some of that £100,000. Let's say you pay your solicitor, who banks somewhere else. Your bank now needs to settle that payment. It does that by moving reserves across to the other bank, at the Bank of England. The public never sees this. It just happens. That's what reserves are. A tool for banks to settle with each other. Not the substance of retail lending. Not what you're borrowing when you take out a loan. And this is why that old story, banks lend out reserves to the public, doesn't make sense in modern systems. Reserves aren't something households ever touch. So to recap, deposits are your money. Reserves are the bank's settlement money. They serve completely different purposes. This is where it really clicks. The old textbook story said, central bank creates reserves, banks lend a fraction, that gets redeposited, banks lend again, money multiplies outward. Reserves first, lending second. Here's the modern reality. According to the Bank of England and Federal Reserve research, banks lend first, then they sort out reserves. When a bank approves your mortgage, it doesn't check its reserves and calculate what fraction it's allowed to lend. It checks whether you're creditworthy. It checks whether the loan will be profitable. It checks its capital position and risk limits. If those things look good, it makes the loan. It creates the deposit. Then, after the deposit is created, after you spend it, after it moves to another bank, that's when reserves move around to settle everything up. If a bank needs more reserves to settle, it can get them from other banks in the interbank market or through central bank facilities. The phrase that describes this, banks don't wait for reserves to lend. They lend, then settle. Now, you might be thinking, does this mean reserve requirements don't matter at all? Here's the nuance. They vary by country. The European Central Bank still requires banks to hold 1% of certain liabilities as reserves. The United States reduced its reserve requirement to 0% in March 2020. And the Bank of England, which oversees our system, has no reserve requirements in the modern framework. 0 in the UK right now. The phrase fractional reserve banking survived. The mechanism most people picture didn't. Okay, so at this point, you might have a very reasonable question. If the reserve fraction isn't the limit, if the Bank of England doesn't require any at all, what stops banks from creating infinite money? This sounds strange, but this is where the real answer lives. Banks are limited by 4 things, and none of them are a simple fraction. First, Capital. Banks have shareholders and bondholders. Regulators require them to hold enough equity, real skin in the game, relative to the risk of their loan book. If you make risky loans and they go wrong, your capital takes the hit. Banks can't lend without enough capital to absorb potential losses. This is the primary structural constraint. Second, profitability. Every loan has to make financial sense. A bank borrows money to fund its operations. It pays interest to depositors, to bondholders. The loan it creates has to earn more than it costs. If interest rates rise and funding becomes expensive, some loans stop being worth making. Third, risk and liquidity. Banks have to be able to manage payment outflows. If everyone starts withdrawing money at once, a bank needs liquid assets, and including reserves, to survive. So the composition of a bank's balance sheet matters enormously. Fourth, borrower demand. Banks cannot force people to take out loans. If households and businesses don't want to borrow because rates are too high, because they're scared, because prices are falling, lending slows down no matter how much capital a bank has. The Bank of England described it as banks being mainly constrained by profitability and solvency considerations. So the real brake on lending is not a magic fraction. It is capital, liquidity, risk, and price. Now we connect this to you because at this point you might be thinking, okay, interesting, but so what? What does the actual mechanism of money creation have to do with my rent, my mortgage, my grocery bill? Everything. Your mortgage rate. The Bank of England sets the base rate, but this is the price of reserves in the interbank market. When they raise it, borrowing becomes more expensive across the whole system. Banks' funding costs rise. They pass that on, which is why your mortgage payment jumped when rates went up. The central bank is controlling the price of money, not the quantity of it. Inflation. When lending is easy and cheap, low rates, willing banks, willing borrowers, more deposits get created. More money chasing the same amount of goods. Prices rise. When lending tightens, that process slows. Inflation isn't just about a government printing money. It's about the whole system of credit creation and how fast new deposits are being written into existence. Why your pay rise didn't feel real. If your salary went up 3%, but prices went up 7%, you got a nominal rise and a real cut. The money in your account went up. What it could buy went down. Understanding this, the difference between nominal and real, is one of the most useful things you can carry away from this video. Never measure a pay rise without checking what inflation did in the same period. Asset prices. Here's something that genuinely explains a lot of frustration. When money is cheap to create, when borrowing costs are low, a lot of new deposits flow into assets, houses, stocks, property. Asset prices rise. People who already own assets get wealthier. People who don't own assets, who are saving for a deposit, for example, find the target keeps moving. This isn't conspiracy. It's mechanism. It's the direct consequence of how credit creation and interest rates interact with asset markets. Understanding this doesn't tell you what to do, but it tells you why it's hard, and that the difficulty isn't purely about your choices. So let's close the loop. Here is the clean mental model. 20 seconds. You should be able to repeat this to someone tomorrow. When a bank approves a loan, it writes new money into existence as a deposit in your account. That deposit is new. It wasn't sitting in a vault. Reserves don't get lent out. They're used by banks behind the scenes to settle with each other. The old multiply up story gets the order wrong. Loans come first. Settlement comes second. And what actually stops banks from creating infinite money isn't a reserve fraction. It's capital, risk, profitability, and borrower demand. Central banks influence all of this by setting the interest rate, the price of borrowing, which shapes how much lending banks want to do and how much borrowers want to take on. That's it. That's the real mechanism. You now understand something that most people who confidently talk about banking don't. And the next time someone says, banks just lend out your deposits, you'll know exactly where the story breaks down. If this was useful, it would help me enormously if you shared it with one person who'd find it useful too. Not for the algorithm, just because this is genuinely one of those things that clicks better when you explain it out loud to someone else. See you in the next one.